predicting Forex market or financial market using the machine learning. So what's the machine learning? It's simply we want the machine, the computer, to read the data, interpret the data for us, and then tell us what to do next. So why do we need machine learning? In older days, we have a small data sets. We have a few numbers to look at. We could easily look at those numbers manually on paper, or later after spreadsheets came out, people started to use it spreadsheets. But now every industry is generating huge amount of data, and that's what the volume. The volume is getting larger and larger every day, and the variety of data is also increasing. We producing now more and more images, and those data have a value in there. So images are not just the snaps or the pictures that we put on the Facebook, but these are the medical images or the other images that are taken geographically, or that's been taken for a certain thermographical images. And there's a different type of text. More and more people now express their sentiments on Twitter or Facebook or different sort of medium. So nowadays, we are producing more text than ever before. So that means the volume of the data is increasing day by day. The variety of data is increasing, and the velocity by which we produce it is increasing. So now it's impossible for humans to comprehend that data, extract the value out of it. So that's why we need machines to learn that data, extract some knowledge out of it, and give some value back. So the machine learning paradigm is you always think about a research question beforehand. Okay, why do you want to do this study? And then you collect the data, or you could already have a data that you want to look at. So you frame your question, you look at your data, and then you do the feature engineering. That's very important. I'm going to be talking again and again about the feature engineering. And that's where we position ourselves. We're not into producing new machine learning algorithm. We are more into using the machine learning algorithm. And why some of the machine learning algorithm works and some doesn't? Because of these feature engineering. We'll get into that in detail. So you do some feature engineering, you generate some features, or you modify your existing features in a way that machine can understand and comprehend. And then you pass it through to the different machine learning algorithm. You visualize it, you analyze it, you evaluate it in terms of in the stock analysis. You visualize, okay, where the market going to go. It should be increasing, but then if it doesn't, that means there's something wrong. So you kind of evaluate it, go back to your research question. In the stocks or this financial market, there's only one goal: to achieve the maximum amount of money. But in other spaces, in the medical space, in the other things, there could be different kind of research questions. You could be looking at, okay, why these genes get regulated? What are the other factors that are influencing in progression of this disease, or how this disease could be cured? So these kind of research questions that you could be modifying as you analyze your data. So this is the machine learning is actually comes into a bigger picture of artificial intelligence. So then there's a machine learning algorithms that we're going to be talking about some of them tonight. And then we have a deep learning algorithm. So we'll just touch upon that. We won't go into the details. But basically, these are machine learning and deep learning techniques comes into a bigger paradigm of artificial intelligence. And there's a steep rise in the use of artificial intelligence. So at the moment, I can only dig the medical journals easily, because the PubMed is one of the place where you go is like a Google for the medical related knowledge. So it's easy to search and then characterize your research. So I just dig the PubMed to look at how the deep learning or machine learning algorithm being utilized lately, and we can see there's an exponential rise in the use of machine learning algorithm, and especially lately the deep learning being used a lot. The blue one is a deep learning. So that means more and more research and application utilizing the deep learning. So we have mainly two types of machine learning for tonight's discussion. We're going to be either looking at the supervised machine learning or unsupervised. So when you have a label for your data, that's our supervised learning. So do we have a label for our financial markets? Yes, we know that we're going to be training our algorithms based on the historical data. So we know for the next 1 week or 2 weeks, our price has gone up or the price has gone down. So we know the labels. So when we know the label, when we can label each of our row in the matrix, in the data matrix, in a table, when we can each row we can identify what that row is all about, then we call it's a supervised learning. When we can't label it, or we do not want to label it, then it comes unsupervised learning. And some of us are already working in some of the supervised learning algorithm, which and trying to look at how we can solve that unsupervised. But that's out of discussion for tonight. So for our financial markets prediction, we'll take it as for tonight's discussion as a supervised learning problem. We have the data. We know for a certain day, after 10 days or 5 days or next day, the market has gone up or down. So we can now label each of our data row by a positive or negative, what happened based on what happened in the future. So we'll take it as a supervised number of machine learning algorithm. Probably I thought about talking about them a little bit, but then we're running out of time. So I don't think I should be going into the details of different machine learning algorithms. But we do need to understand what the model is. So when we talk about the model, they are just been saying, okay, we need to train our model. So the model means we give some values to a mathematical formula, and that mathematical formula give us back the result, the y. We feed in the x, we get y out of that. So that could be any sort of equations. So what's y? Y is our label. So we want to have a mathematical formula where we feed in some data for that, considering it as a x values, and then it should give you the y, the label for that data. So it could be something like that, that you have this table of values. So let me grab my pointer here. It'd be nice to draw pen. So this is our data. This one where we know the refund, the status of a person, the income of the person, and we have the label for each of the row. So this is our label, which is, we can say it's a y. So for each of the row, we can label it if that person has cheated or not cheated. Okay, and the same for this one. This is different data. So we have, this is our x, and this is our y, the label. For each of row, we have the label. So we want a mathematical model to train on this data, and then when the future data comes in, so this is our future data. So this is our future data. When the future data comes in, we should learn that data based on the previous learning, and then spit out the label for it. And then when we have trained our algorithm, then we can test it. If we have put aside some data to test it against, then we can say, okay, it was a right prediction or the wrong prediction. And then you want to try it. The whole idea is to train and test, and then make the algorithm ready to work for some future values. So we are usually in this paradigm, we talk about the underfitting, overfitting. When the model is not properly trained, when we haven't fit it properly according to some data points, then it's a underfitting. So for this one, as we can see, there's a parabola, there's some sort of shape going on, and we have just written a mathematical formula which could draw just a straight line. So then it would be underfitting. And on the right, it could be underfitting when we write a mathematical formula in a way where it touches each and every point. Then it comes overfitting. So that means it will not work well for the future values. So we want this sort of mathematical formula or model which kind of represents the data well, but it doesn't really touch each of the data points. So neither is underfitted nor is overfitted. So we want this sort of models. And this is another examples of classification. This is underfitting. We're missing some points. And then on the right, we're kind of fitting each and every point. So we want this sort of model where we could miss out some of the data points, but that's okay. But in a majority, we have covered the points. Okay, so here's an example. What do I mean by mathematical formula? So let's see. Here we have some data points, and you have some x values, and for any x value, we want to predict the y value. So we can see a clear trend, a rising trend in this one. And by looking at, we can see we can fit a straight line through it, right? Anybody remembers the equation for straight line? C equal to y? I don't think it's this one. Y is equal to mx plus c. That's right. That's the textbook's equation that we learned ages ago. That might have changed in late textbooks. So y is equal to mx plus c. So what was the m? Was the slope. And in this one, I'm representing here with a beta. So that's my m. And that's my c. I'm representing here as an alpha. And this is epsilon is my error. So this is a simple example of a mathematical formula that can represent a model, and we can use this model to predict the future values, right? And then we usually talk about this error, how much is the error, and we usually talk about the sum of scared errors. So that means that how much away is this line from each and every from the data points. So this, we basically take the difference from the line and these data points and then scare it. The reason, because we want to get rid of the negative sign, we scare it and then we sum it. So that's why we call it sum of scared errors. So the bigger the number, the bad is the result. So we want this number to be the smallest possible. So whenever we have a SSE for any model, so we want the smallest possible number. So you could have this data, you tried one machine learning model, you got a number, let's say 10. You got another machine learning model, you got a number, let's say 5. So the machine learning algorithm that giving you the number 5 is better than the other that giving you the 10, right? So that's the whole paradigm. And we can show this as a residual plot as well. So we are usually interested in looking at how much my model is missing the value. How away is that? And we could, that's what we call the residual, the error, the actual error. The residual mean is error here. How much is away? So on this plot, we have on the x-axis the predicted value, on the y-axis is the error. So you want your values to stay as close as possible to this 0. So which means you have a minimum error. So you got a model that giving you the minimum error, and you only missing few of the data points. So if you trained a machine learning model and you have plotted it, and you get this kind of plot where you have very few values below the 0 and very high values, or more number of values above on the y-axis. So this is your model is no good. Even in this one, this space, on the right side, this one, when you increase your number of predictions, your error getting increased. So that means this model is no good either. Or if you have this sort of situation, when your prediction is small, your error is very high, prediction is reasonable, your error is somewhere in between, but then when you increase the number, your error becomes very large. So you don't want this sort of situation. Or this sort of situation is acceptable in our example, the Forex one. You're only missing out a couple of values, and most of the time you are fine. Most of the time you have very small error. So you are good. In this example, you are fine. You're done. So you want this sort of model for your financial markets. It's good. So that outlier could be anything. And that could be Trump effect. Okay, so now with our financial market predictions, we can take it as a classification problem or as a regression problem. So regression means we want to predict the exact value of a stock. For example, today's price is $100. We want to predict how much it will be worth after 10 days. So that's regression. But you can formulate this as a classification problem as well. You can say, okay, I want to know those stocks which I can buy today with a 1% gain in next 10 days. So then it becomes a classification problem. Yeah, does it make sense? It's an important concept. So we can formulate this problem as a regression or a classification problem. So the example we're going to be looking tonight is a classification, where we will say, okay, I want my stocks or my financial market or my Forex market or my cryptocurrency, which currency going to give me 5% rise in the next 1 month? Becomes a classification problem, right? You just want to classify. You want to make two classes, one with a less gain, another one, the bigger gain, right? And then probably skip that one. Okay, so we don't have to do a lot as a data scientist. Hard work is already been done. All we have to know is there's a Python library and a bunch of lines that you have to write to have your work done. And most of the time, we use Python, very favorite nowadays, as Philip just mentioned. In one of the surveys, it's been the #1 language, preferred language for data scientists at the moment. And it has a lot of free modules already been there. So you have the modules for regression, for clustering, for classification. Pretty much everything is being solved. So all you have to do is to learn that you got to run this statement, why, this statement, why, this statement, why, and then this statement, what does it do? And then how to feed in data, how to read in data, how to interpret the data. That's all you need to do, right? Okay, so with our couple of examples that we're going to be looking, we'll be talking about the accuracy or precision, recall, F1. What are these? I think most people would know what the accuracy means. Accuracy could be deceptive in some of the markets. For example, I can say my model have an accuracy of 95% in predicting the stocks. Okay, what's that 95% mean? So my model tells me that whenever the price going down, it tells me 95% of the time correctly, but the 5% that it gets wrong is a buy signal. Whenever my model says buy, it actually gets it wrong. Is that acceptable? Not really in the stocks market. In the stock, we are mainly focusing on buy signals. We want to buy a stock because the shorting concept in the stocks doesn't really exist. Does it? Can you back me up, Andrew? Do we have a shorting? Does it a lot of shorting being done nowadays? You can, but it's very hard for the general public. Yeah, we don't go into that concept. Shorting, you can, to keep it simple. In the stocks. Okay, we need to talk about that afterward. Because general public can't do the shorting. It's very hard. It's very hard. It depends on the broker you're trading with. And the broker has a full control on, they can liquidate your position at any time. So it's a difficult paradigm. So for general, I do know what you mean, but for general public, we'll just say, okay, shorting doesn't happen in, though it does, but we're not in that game. For stocks, you want your buy signals to give you the true results, to give you the accurate results. So you don't want to get your buy signal wrong for normal people. So that's when that precision thing comes in. So you can, it's your percent of correct system predictions. So it's the time, well, the true value, you can say, okay, my buy signals are my true positive. So I want to get this one right. So then you concentrate on the precision thing. But if you are really into shorting business, then you can more look at the recall thing. Yeah. Okay, so now I give you a couple of examples for the medical where we applied the machine learning. Machine learning has been doing great things. And then I relate this work with the finance, and I'll explain how. Because it's just a feature engineering problem. It's just a same sort of features that we do in the medical space. So this is the work I'm been showing that's just done some of my students' recent research. So in one of the projects that we just finished, we looked at the handwriting data coming from the Parkinson disease patients. So it's a neurodegenerative disorder. In this, as you know, people have a difficulty with walking, writing, and then their writing goes wiggly. And this is a drawing that's been done, traced, a spiral being traced by a normal person. And when the patient's disease gets worse, his writing becomes worse, as is being shown on the right. So it's kind of financial market, isn't it? It's going wiggling up and down. You never know where it's gonna go. So we had this data. So then what we done, we obviously acquired the data, and then we looked at the features, and that's where the financial market or any data science field has a similarity. Whenever you've been given a data, you kind of explore the data. You always look at the data exploration. You always look at if there are null values. You always look at what's the problem with the data. Are there anomalies there? Are there outliers? So that kind of analysis are always there. It doesn't matter what space, what kind of industry you're working in. It's always there. So that's why some of the core competencies for the data scientists are the same, irrespective of the domain knowledge. So in this one, we generated lots of features. For example, looked at the width, how the person is drawing, how fast it's going, the velocity, the acceleration, the stroke speed, the duration, the jerk, is it backward, how much pressure is being implementing, in-air movement when its pen is not touching the pad. So all this kind of features being generated. There's a long list of features. So that's what you do in the financial market as well. You generate a number of features, because the raw values not gonna work, are they? Has anybody tried feeding into machine learning algorithm the raw data? I'm sure one of you would have tried that. None? Okay, if you haven't, no point trying it, it's not gonna work. So the raw values coming straight from market, whatever the market is, Bitcoins or stocks or the Forex, if you straight away feed those values, those numbers, straight into any machine learning algorithm, none of the algorithm will work. So that means you have to generate these sort of features which kind of give you something, which kind of make your whole paradigm, your whole problem in a simplified way, in a repetitive way, where you could see some patterns that are repeating. You have to convert that your raw data into different sort of features. So we converted in this project long list of features. You don't need to go into the details. But then after generating these features, then you feed into data to all known algorithm. As I was saying, you don't have to devise the algorithm. The fantastic work has been done by the genius people in the world. So, and we could achieve by this one of the very famous machine learning algorithm, random forest. We could have achieved the accuracy of 0.99. That means the 99% of the time we were able to accurately predict that whether this drawing has been drawn by a patient or a normal person. And then we also looked at which are the features that's contributing to this accuracy. So it turned out to be that we only actually need 3 features to predict that. We don't need that long list of features. So how would you know that? You wouldn't know that unless you have done the work. So you have to, so that's what you do in the financial markets as well. Okay, that's another project where we looked at, if it's gonna start. Okay. And it's supposed to, I had a video of a person with a Huntington disease, another neurodegenerative disease where just a person walking on a pad and we capturing how the person is walking. Again, the same thing we've done here, we captured the person's walk, we generated a range of number of features, the distance between the legs, and how the person is walking. Again, the same thing. We generated maybe, probably can't remember, more than 50 features, but then it's turned out to be that we only need 3 features to make a 97% accuracy. So that means we can, just looking at how the person been walking, we can predict or we can tell the person's severity of the disease very accurately, only using 3 features. Right? Another project where we looked at the risk of prostate cancer. Again, large number of features being generated, and then we came up with that you only need the rate of change of PSA to predict the person's risks of developing the prostate cancer. And so on and so forth. We have lots of other projects, but that's probably enough. And now we get into that, the machine learning for predicting these financial markets. So it's the same thing. It doesn't matter what market you're working with. Either you're trying to predict a price of a cryptocurrency, or you are into predicting the stocks of any country, or you want to predict the price of a Forex. So if you just feed in the raw numbers, it doesn't work. It doesn't work. People have already tried that. So what you have to do, you have to convert this data into some sort of features. So that's when we get into those technical analysis and the fundamental analysis. Okay, so in the financial markets, there's a theory called Elliot wave theory. And the theory says, and the person who I'm collaborating, the market guy, who's actually looked at that in a very detailed way, he's claiming that for last 200 years, all the financial markets predicting the same phenomenon. They are working based on these Elliot wave theories. According to this theory, whenever there's a bullish market, the market goes up, it goes up in 8 cycles. So first it gets a wave 1, impulsive wave, and then it gets a retracement of a wave 2, little bit down, and again another wave 3, very strong wave, retracement of a wave 4, again after getting a peak, wave 5, and then it gets a retracement in three waves, A, B, and C. And that's your bullish. When the bullish means the market is increasing, market is going up. And the bearish means when your overall market is coming down, is reducing in the value. So same way, the bearish market, you get the same 8 waves, but in a different little bit cycle. Now your impulsive 5 waves are towards the downward. Is a wave 1, 2, 3, 4, and 5. And then your retracement is in 3 waves, A, B, and C, but in the opposite direction. Happy with that, everybody? Okay, so I have personally also looked at, and I'm kind of also convinced that yes, all the markets behave in this pattern. But it's very hard to predict. Easy to say, but hard to predict. Okay, another concept. The project, one of the project that one of my student who's not here, unfortunately, he had to go somewhere. Otherwise, he could have presented himself. He looked at the prices of the stocks, and he looked at companies' fundamental indicators and its technical indicator combined together. So what do we mean by fundamental indicators? So we only get that in the stocks market. Usually for the other markets, for Forex and the cryptocurrencies, we don't really have much of the fundamental analysis. But for the stocks, there's always a value in the fundamental analysis. So in the fundamental analysis, you look at the company's revenue, who's heading the company, how much the profit is the company is making, whether they are able to pay their back debts, what are their competitor markets, that kind of indicators you're looking at, the fundamental. If a very strong person becomes a CEO of a company, that has an effect on his price. You know, that comes under the fundamental analysis. But on the other hand, the technical analysis, you only look at the price of a stock or Forex, whatever it is. So you only look at the prices, and you generate all of your features using those prices. Either the opening price of the stock, or close price of the stock, or high value of the stock, or close of the day. Or you can also take into account the volume, how much the stock's being traded, that sort of indicators. So in this analysis, we had 2 assumptions that these values have an effect on the price of the stocks. And we also, whenever we want to predict any market, we have an assumption that the historical prices has an effect on the future prices. And you usually hear that disclaimer, don't you? Whenever you sign to a financial company's advice, you usually get that disclaimer that the historical prices are not the indicator of the future prices. But then we are in the data science space. We always work in this paradigm that the historical prices predicts the future prices. So we are here with this assumption. So here's a quick example of this. There's so many indicators, and Ling has, who was the lady who was here before, she generated more than 50 indicators, or how much did you indicated? Can't remember from top of my head, but so many indicators. There's so many famous indicators that's been used. Here's just a quick example. We have a bunch of moving averages and MACD. What these indicators look like. So here's an example. So we have this example obtained from commodity.com. So here's a candle chart of a stock. Is a NASDAQ 100 ETF QQQ. So these candle charts are made based on the opening price, and then the closing price, low price of the day, and the high price of the day. So the color is green when your closing price is higher than the opening price, and the color is red when your closing price is lower than your opening price. So using just these price data, you can generate some moving averages. And MACD, there's a bunch of MACD indicators that you generate using a 12 period exponential moving averages, minus 26 period exponential moving averages, and then you have a signal line of a 9 period exponential moving average. When I say 9 period, that means 9 bars. So these 9 bars could be 9 days or 9 hours or 9 minutes. That depends your time frame of analysis. If you are analyzing your stock prices hour by hour, then you will, for 8 hours, you will have 8 bars. Yeah. If you're analyzing your stock market after every 2 hours, so that means for 8 bars, you will that must be the 16 hours, but the stock market is only less than bucks for less than 8 hours, so that means it would have gone to the next day, right? So that depends your time frame that you're doing analysis. So that's why you have a period here. It's been set period. 9 period mean 9 bars. So that bars could be anything. It could be days, it could be weeks, it could be months, or it could be minute or seconds. And then the histogram is this one. These are the histograms. So now here you can see some kind of trend. You can see, for example, let's see, look at this one. Look at this line here. If you're just here looking at the price, it doesn't tell you whether the price going to go up or down. But if you look at the indicator, there's a clear indication that the price are heading down. Yeah. Or look at, for example, look at this one. Look at example here. Just looking at the price, it doesn't really make sense whether the price will go up or down. But if you look at the MACD, there's a clear indicator that a crossover has happened. So that crossover signals the market is going up. This crossover. And the same thing here. On the other hand, so this is only one indicator. You have so many other indicators. This is another indicator, relative strength RSI indicator. So that indicators usually goes between 30 and 70, sometimes goes up. Theoretically, is from 0 to 100, but usually is oscillate between 30 and 70. So whenever it touches 70, so that means the market is overbought. That means so many people have already bought it, so now they're going to sell it. So that means if you have already opened a position, you should sell. And whenever it touches the 30, that means the market is oversold. So that means now lots of people are going to buy the stock. And now you can see this is a stock of eBay. And just on this indicator, you see whenever it touches this 30, this line, the bottom line is a 31. There's a little increase after that. Yeah, after this one. And then whenever it touches the upper line, then the price of the stocks after that goes down. So this is just an example of two indicators. Usually the people who are doing the technical analysis, they look at so many other indicators, Fibonacci series, these different moving averages, MACD, so many things they look at. So now we want to do this whole, we generated this bunch of this. Again, you don't have to generate the data. There's a Python libraries being already written. All you have to do just to use the right Python library, right code, feed in the data. It will generate this number for you, right? So then for our stock, for this stock learning project, what we have done, we framed it as a classification problem. So we could have done it as a regression problem. You predict the exact price of the stock, but it is easier to deal it as a classification problem. And then we labeled each of our row for the next 10 days. So for each of the row, obviously you can write a Python script for that. You don't have to do it manually. For each of the row, you go next day and see if the market gone up, how much up, or down, label that row. go to the next day, second day, look at the market price against your 0th row, and then based on that. So that means for each of the row, now you will have 10 additional rows indicating the price from next day to the 10th day, right? And then we randomize the data so that our machine learning shouldn't know any trend. So we want to predict based on just on each of the line. We wanted to do the prediction. High accuracy could be deceptive. I've already spoken about that. And then another thing you should be taken into account, look at your data, explore it, see your classes could be uneven. You could have a loss of examples of sell, but only very few examples of buy. So your classes should be even. The buy classes and the sell classes should be even for, if not exactly even, should be comparable. It shouldn't be like that, like you have a 10,000 examples of sell, but only 10 examples of buy. Then what your machine learning going to learn? It's going to learn the sell, not the buy, right? So that's what, again, similar framework that you would do with any data science project. You get your data, do feature engineering, do your cleaning, remove the nulls, have it a little bit explored, visualize, and then you start your evaluation. For this project, we downloaded quite a few fundamental indicators. Few of them are PE ratio, is the price to earning ratio, and then price to book ratio, quite a few earning estimate, and then quite a few capital expenditures, return on assets. So these were our fundamental indicators. And then we generated a bunch of quite a few technical indicators, volume, market cap, and then short ratio, short interest ratio, quite a few analyst recommendation, equity positions, hold and buy recommendations, long-term target price, standard deviation of last few days, that kind of thing. So you have all of this data in one row, in each of the row, and you got a labeling, right? So what do you do next? Just I talked about the labeling. Yeah, it's the way we done the labeling for each of the row. We looked at we set up just arbitrary number is a 1%. We were interested in making 1% profit, right? You could say, oh, I'm not happy with the 1%. I want to make 2% profit, 3%, whatever. So we just thought, okay, 1% is a reasonable profit. You spend, you invest $100 and have a $1 profit. That's enough. So for each of the row, then we looked at the next day, from next day to 10-day ahead. And if the price has gone up 1%, then we label it as a buy. And if the price has gone down 1%, then we label it as a sell. And if the price have oscillated between that, didn't touch each other, then it's a hold position for us. Yeah? Make sense? Any questions so far? Because that's the hard work. The rest of the work, the machine has to do it. So this is the work that you have to do it. All this feature engineering, getting the data in a right format, that's all a data scientist has to do. Make sense? Okay, so the next step is just to basically run through all machine learning algorithm, whatever you can find. And it's not that hard. People who are new in this space, they would say, oh, you know, these names are very hard. It's just a one-liner. For each of these commands to run, you only need to change 1 or 2 lines. That's it. It's just a simple copy-paste. And then here are some our results. So for these 5 algorithms that we tried, we've seen that the random forest, and that's where, you know, some of the medical projects that I showed before, the random forest also worked well over there and here as well, you know. So for some of the scenarios, we've seen that the random forests are very good. It's a decision-based algorithm, decision tree algorithm. So for and another thing we observed that we are better in predicting the stock prices for the 10th day. For all of these one, for using all the features that I showed you before, the fundamental and the technical combined together, we could achieve 83 point something. But with doing some exhaustive feature learning, we could reduce some of the features, and actually our accuracy gone up. And I meant to have the confusion matrix. I think it's lost somewhere. So that shows exactly how much the true how much actually we had a sold and buy. So I think I don't have a slide for that one. Okay, so the next one is the next project. So any question for this one? Yes, we got a question on the back. Sorry, on? It's all historical. Yes, we haven't tested in a real time. That's what your question is? Out of sample though, or is it in sample? Out of sample. Yes. So yes, with all the machine learning algorithms, you train your algorithm on a certain data, and then you always keep some data which your machine has never seen, never explored, and then you do your prediction based on those hold-out data. So in this one, so far we only tried hold-out method, but I think Jadib has also tried the tenfold validation, and the results were pretty much the same. Yes. So you're using the time premise for the daily? Yes, we use the daily data. I'm curious, like if you're using like the moving average, then how do you use the price indicator? The what value can you extract from the moving average? So moving average depends what's the moving average. If it's a 10-day moving average, that means for each of the 10 days, you take the price of the 10 days, you take the average, and you get one value. And you do that for each of the day. So you moving average means you continuously moving. You take 10 days from here, you take the average, you put it here. And then you move next day. Next 10 days, get an average, another day. Make sense? No? If I have a pen, I can draw for you. No? All good? Yeah. Yes, there's a bunch of steps that I skipped, didn't get into the details, because I know quite a few people here are new to the machine learning environment. So we've done the scaling and normalization. Which method did we use? I think the Jadib has used, can't remember from my top of head. The 0-1, yes, I think. Yeah, but it doesn't matter. We tried that in quite a few other projects as well. It doesn't matter what sort of normalization you do. Usually it doesn't matter. That's the scaling is between 0 and 1. And even with the normalization, there's so many normalization method, the mean, the average, and so many. Usually it doesn't make much. In some of the cases it does, but most of the time the standard methods work well. For the scaling, I think Jadib has done from -1 to 1. The scaling, all values being scaled between -1 and 1. And then for the normalization, I think is done the standard normalization, which is the mean based. Very nice question. Are you been trading? Do you do trading? Yes, that's why you could have asked this. Very good question, very valid question. Maybe many people wouldn't have understand that. So that's why I think this algorithm will only work. Okay, it will work for the future values. The reason is that Initially we've taken this loss of data, and you have done, but then we broken down to some certain indicators which are independent of the values, which have nothing to do with the values. And our research paper is just in a production. Probably I wouldn't release them tonight, but yeah. So this will work for the future values. But your question is very valid. If you would have relied on the technical indicators, yes, then it will not work for the future value. There's a good argument. But the indicators that we settled on, they are independent of this thing. So it has a potential to work on future values. Yes, we've got a couple of questions here. Yes.
Use technical indicators on the moving trend and apply the machine learning algorithm on that?
Yes, why not? That's what we've done. And the next project that Dr. Soket probably going to be talking about, and Ling has done that nice work. So they're going to be talking about the same thing. Yes. Yes. Say the question again.
Resampling. Because you said you use the daily price.
Mm-hmm.
It's mostly day back, but I saw some research that these daily bars do not have good statistical properties.
Daily prices do not have the good statistical prices. That's what your question is.
Yeah. So if we use the resampling, resampling by volumes, do you think it will have a better performance?
No, I don't think so. Yeah, I mean, you can try whatever you think is appropriate. But for other people to know, your question is basically we should have sampled based on some volume or that kind of things, and that could have worked. So that's one theory. So you could have that theory, and then you can do and test for yourself. But based on my knowledge, I don't think it's going to work. But you could be right. I don't know. I haven't tried it myself, So I'm just based on my historical knowledge of the field and the machine learning. But you could prove me wrong, and it does happen. You can say, oh, let's try this, and that's what the research question is. Initially I saw. So this is one of your research questions. Say, I got a research question that I should have a sample based on the volume on certain days, and then use the machine learning. That's a research question. Go and test for yourself. Yes, I haven't tested it, but I don't think it's gonna work.
Do some statistical analysis.
Yeah, long gone are the days when people rely on the statistical analysis in this field. Not anymore. Yeah.
Is it better to use the machine learning on a smaller time frame rather than daily time frame?
You can try on any time frame. It doesn't matter. You can do 15 minutes to 30 minutes, 1 hour. It doesn't matter. The longer the time frame, my theory is your prediction should be stronger.
Exactly. Yeah.
So that's why we just stayed on the one daily time frame. But then the next project, he's going to be talking about, we used the 15 minutes, and it did work well there as well in the Forex market, but not in the in the stocks. In the stocks, I think the daily is a good thing, unless you are in a frequency trading.
If that's the case, then you just make machine learning bot. Everyone make machine learning bot to trade with lower time frames, sub 1 hour time frames.
But you can't beat the big giants who have
trade in the high frequency.
Yeah.
Time 1 minute, 5 minutes.
Oh, not microseconds. People are dealing in microseconds. High frequency traders. So we can't beat them. Just face the reality.
We can be traders in the 5 minutes, 15 minutes. Though.
Very hard. Very hard. I think again, that's your research question. You can try for yourself. You are in the degree, and you got a data. You can try for yourself. but I think it's going to be very hard. There's so many. Yes, and
Someone did it. You said someone made an accurate plot.
no, but that's a 15 minutes. Yeah, not the 5 minutes. 15 minutes, a little bit more stable.
What
Yeah,
was the accuracy?
it's good. He's going to show that. Yeah.
I'm just curious what the neural network architecture was that was used.
It didn't perform well in this space, but the truth is we haven't tried much. I think there's a potential to even go higher. 85%, we can touch 90% or even higher with the use of more sophisticated neural networks. We just for the sake of this research paper, we just wanted to say, oh, we tried neural network. He just tried very basic perceptron, couple of hidden layers, and just to show that it doesn't work. But that's the future work. Yes, there's a space of work that we can do.
So in the same vein as that question, you use all machine learning algorithms. And I know you said that features are more important than what the algorithm they use.
Yeah.
But if you had, in your opinion, what those financial giants that are trying to create these models, what kind of algorithms do you think they're using? If you had to name some, would they be using deep learning? Or are they...
All sort of things. People, the reality is there's so many algorithms at the people doing a different sort of algorithms on different time frames. And you could have a deep learning algorithm telling you the monthly trend. And then underneath, you could have a machine learning algorithm telling you, one machine learning algorithm telling you the weekly trend. And then the other algorithm could be telling you the daily trend. So you could have a range and layers of your prediction models. And then you can plan for, okay, the market is heading to the down, but I still don't want to miss those small spikes that goes up. But then you would know that, okay, the bigger picture is market is overall going down. If I do open up a buy position, I would liquidate it quickly within a short period of time. So if you do some sort of study about these hedge funds, they use all sort of things.
So in a lot of cases, machine learning algorithms are better or just as good as deep learning algorithms.
Depends. You know, yes. So like deep learning has shown very promising, and we're going to be trying deep learning more and more in this space in the coming projects. But and some of the people have shown good results with the deep learning. But it depends, like how much you have tweaked the algorithms. Yes, I.
What is the actual job of data scientists? To write these algorithms, or to use them, or to create the features? What actually data scientists? Because for a layman person like me, I'm not getting much idea out of this. For example, if I have to become a data scientist, what I will be doing in a nutshell? Okay, so the question is, if I'm a data scientist, what I will be doing in this whole presentation? What's the role of? So this, if you are a data scientist, you're going to be doing all this kind of stuff. So your employer, talking about this financial market space, he would be sitting there with the money in his hand and asking you, okay, Zahid, tell me where to invest, which stock to buy, which to sell. So this all work is for you to tell your employer where to invest. And in order you to tell him, you have to do this all work, have to do that feature engineering. You have to do this plotting, because without plotting, you can't visualize what's happening. So you have to do this all work for yourself. And then you kind of present your employer if you want to, and if your employer trusts you enough, they can just give you the money and then ask you to invest on his behalf. Absolutely. No, but yeah, sometime if you want to increase the accuracy even beyond that, then you'll be looking at maybe tweaking the algorithms as well. So that's why some of our courses also talk about writing these low-level algorithms. And sometimes students complain about that, oh, why do we need that to write our own deep learning algorithm when it's been already written? So that's the point of it. If you don't study in university, when you're going to study it?
So you need to know some of the algorithms under the hood, why they are there, and if you ever need to write one for yourself, how you're going to write it. And then if you need to change any of the algorithms, then obviously you have to start from the scratch. You have to write it for yourself. But most of the time, you don't need to do that. We downloaded about 10 years worth of data, but then we realized there's so many null values and missing values and blah, blah, blah. And then the quality data that we left with were only worth about 2 years. 80-20, 80%. 80% we use for training and 20% for testing. Mm-hmm. For each of the row, we're making prediction. 2 years worth of data. 2 years. Daily, yes. Hmm?
You only have around 400. And you also split by 10. What's the ratio?
80-20.
So then you
For machine learning is, yeah, that's a good argument that the data is not enough, but for machine learning I think it's okay to have your something your hypothesis be tested. For deep learning it's not enough. So that's why the neural network didn't work well here. That's one of the reasons we didn't have much data. We ended up on 4 features. Yes. We randomize the data. Okay, so the next project that I'll request Dr. Saqib to present that.
क्लियर कैसे हो ये अब तो
ये मैंने पॉइंटर
Good evening, everyone. So this is the project which we did last semester, and I'm happy to present. This is Ling's project and her team members. They did very well in this project, and this was about the financial trading in Forex markets. As you have understood that this is a graph or a bar chart for the financial trading in Forex market. Each bar or each candle represents one unit of time. So that unit of time can be a daily time or 4 hourly or hourly or 15 minutes. So what we looked at was 4 different time frames, which was daily, H4, H1, and M15. We also looked at almost 14 currency pairs, different currency pairs, and we looked at almost 14 years worth of data. So we trained our model and tried to come up with a model which can predict whether the market is going to go in certain direction and can make certain amount of money. Now, if you look at this one, these green and red candles are just the normal market data. These green lines, the straight lines, they're called zigzag indicators. So this is one indicator. So we have normal market data, and then we have the indicators. There are almost 50 or 60 indicators which you can calculate based on the raw data, which is open, high, low, and close. So Ling and her group, they did some calculations or some algorithms to convert the raw data into the zigzag indicator. And they use, this is one of the indicators. Now they have used other indicators, they have used other features, indicators as their features in training their model. So this is just one of them. So essentially what they did was they tried to predict a point in time, a point in the market, which can give us high probability trade, which will result in profit. So if you look at this graph, it's a bit dim here, but if you look at the graph, which is the arrow pointing up, this one, so these are all the candlesticks. So these are the candlesticks representing the market. So if you imagine that you are, the market is here at the moment. So we don't know what's going to happen next, whether it's going to go up or down. That's the main question. Now, at this point, this purple circle, it represents this is a significant point in time. This is a significant point. This is an event which has happened in the market. Now, this event can be detected, can be found by using the zigzag indicator. So that's the purpose of zigzag indicator. So we have used the zigzag indicator to find out this purple dot, this first event, and we call it event 1. So once we have this event 1, we wait for another event to happen, and that event is detected with the help of some other indicators. So that other indicator is basically moving average. The moving average has an event which is a crossover. So if you look at this one here, so these are two moving averages, different window sizes. So these two window sizes, these two moving averages, they cross each other at some point in time. So when this thing happens, this is our event 2. So this is our second event. We have found that once the event 1 has happened and event 2 has happened, we can find out another third event. The property of that event is that after that event has happened, market goes in one direction. So in this case, when this event will happen, market will go down, and this is what we have verified. So if this is our event 1, this is our event 2, we want to find out a point in time when the market, after that, the market will go down and will not go up, and there are some conditions to that. So if you look at the graph here, this is the point after the event 2 has happened. This is the point after which the market has gone down only. It has not crossed this point after that. So we want to, the problem was that we want to identify, we want to classify this point, that when this point has happened, this is the perfect time to do the trade, because after that the market will go down only. So this was the problem, this was the classification issue we were trying to solve with the help of machine learning. So Ling and her group, they used around 63 features. They did a lot of feature engineering. They did a lot of work in feature engineering. They had 63 features. They had 63 columns to be used to predict whether this certain candle is tradable or not. Now, these 63 columns, they had to reduce them because when you have more columns, it does not mean that your results are better. So they had to reduce them, and when they reduce this, they use PCA, MCA, MFA, and I'm sure when you will be studying this subject, you will understand what are these algorithms. So what they did, they had to reduce these 63 columns into 37 columns. They used these PCA, MCA, and some other algorithms. And once they have this 37 columns, they had to train their models. Before training the models, they had to label it. So as I mentioned earlier, they had to use certain magnitude in 3 directions, whether it's going to go up, down, or it will not do anything for certain number of bars. So this is what they did. So top barrier, top barrier profit taking, bottom barrier is stop loss, and the vertical barrier is that after which you don't do any trade. So you wait for these number of bars and you don't do trade if the market does not go up or down. So this was their pipeline. So they had so many features to be used. They combined 14 currency pairs. They did the experimentations. One of the problems, as Matlub has mentioned, they faced was the imbalance of the classes. So they had to solve this issue. They had one class, which was the true positives. They had this class outnumbering the false ones. So they had to use some algorithms to do this. Then they had this feature reduction, classification models. They have used so many classification models, experiments, and then at the end, they did the verification. And these are their results, the final best performing results. And as you can see, the last one, the KNN, it gives you almost 97% precision. So why we are after the precision, as Dr. Matlub said, we are looking for the points when we do the trade, it is the right time to trade. So these are the results. So what does this mean in terms of money? So they did train the model. When they trained the model on 14 currencies, different time frames, they tested that model on 4 or 5 different currencies and in different time frames. And they tried to use that model to predict whether it's going to have a tradable point or not. And they used that model on 14 or 15 years of data. So these are the results. So they have almost every time they have correctly predicted positives outnumbering the wrongly predicted negatives. And these are the total profits in terms of pips. If you don't know what is pip, pip is the basic unit in trading. So 1 pip is almost equals to 10 Australian dollars. So you do the calculation, total profit in pips over 14 years is 26,000, and you do the calculation and it comes out to be almost 17,000 per year. So when you do the trading, you have the unit of trade, and that unit of trade is called a lot. A lot is almost $2,000 worth when you have 50 times leverage. So that is, if you invest $2,000 every year, you can make 20,000. That's too much. Too good to be true. Yes. Sorry?
You're calculating the profits in pips,
Mm-hmm.
but then you're saying 1 profit. So I think you're missing the conversion to
So when you do the calculation, so how many pips you have made in total? So these are the total pips over 14 years. And one lot profit, if you invested one lot profit, then you had made, which one? This one?
19,120. Because, yeah, I thought that it was a 15-year price of 14.
Oh, okay. All right. This one. Oh, yep.
This one should be at 19,120.
Okay. All right. So these are the testing results. These are not the real result. We didn't make this much money. We tested it on 14 years of data of 5 different currency pairs and 5 different time frames. And this is the result. If we had used our model on these time frames, on these currency pairs, we would have made this much pips or these many pips in those years. So this is the result, and I'm happy that Ling and her group has done a good job in this one. And this is not the end. We can go forward. This is just one way of doing it. There are so many others. We have used a few indicators. We have used a few events in those indicators. So those events are basically representing a few number of points in the market when you can do the trade and when you can do the profitable trade. So that's what we are heading to. So we are heading towards more branching out in different directions using different events, different maybe models to use, and then find out if we can do better than this one. And also we want to test this one in real time on the real market. What's going to happen? We have almost 40 currency pairs. Each currency pair can be traded in different time frames. So let's say 4 time frames. So you do the multiplication and find out how many times we can find out the events 1, 2, and 3, and then do the trade. And 97% of the time, our model tells the right time to trade, and that's where the beauty is, because it's going to make you money.
Okay, so we take the question.
When you worked out the profit, did you use the bid offer spread in the calculation?
Sorry.
Or was it all based on mid-market pricing?
So I think in this calculation, we haven't taken into account the transaction cost. That's what you mean? Yeah. So the transaction cost hasn't been taken into account. So it's been just straight whatever the value is coming out. So obviously the actual profit and also the bid spread, if you understand that, that also not been taken into account. But look at the margin. Investing $1,000, you make nearly $1,000. Cost, not much. And then on the top of that, you can, when you make the money, you can invest back. We're not taking into account that. And thirdly, they haven't taken into account the running profit. Like they had as they were showing the 3, they had a fixed window to make the profit. So if you hit that window, that's it. You make the profit, you exit. But in reality, you can let your profit run. So that means there's an opportunity to even make more. Yeah, you lose some in transaction cost and in some in the bid spread, but there's also opportunity to make more.
So what is leverage?
So the leverage mean like like going to the bank and paying it at 20% for $1 million home. You pay him $200,000 and buy a $1 million home. So one lot costs you $100,000. So you can only pay $20,000 or $2,000 and trade using that $100,000.
That's what the leverage is. Did I get it right, Bling? Yeah. Got a confirmation from the expert. For 2,000, you can do million. Yeah. Okay. So with the 50 times. All right. Here you go. With the $2,000, you can trade up to the million. That's even better. That means the actual profit could be even higher.
A million notional.
So the one lot, one lot cost you $1 million in real money, or yeah, 100,000. I think that's what I meant. Okay.
Thank you. For 20,000 profits, have you considered the trade cost like a rollover fee?
Yeah, that's what we was.
Oh, but that may be a large sum of money if considering rollover fee. So the profit may be much less than this.
Yes.
Okay, thank you.
So we got a question on the back. So the question from the part. So this.
So just curious, because you say that your start date is 2005 and your end date is 2019. So my first question is, when did your training data start and when did your training data finish?
So we started 2005, 2019, but we trained on different currency pairs. We didn't use these currency pairs.
Okay. And
so we didn't use these currency pairs. These were unused, unseen, and we had this for testing. We wanted to test how our model would have performed if we had used this model in these 15 years.
And are those currencies totally uncorrelated to the ones that you did test it on? Sorry,
so
did train it on?
Maybe Ling can answer this one. Did we try this one, Ling, the correlation of currency pairs? I think our model was standardized so that it works on related or unrelated currency pairs. It doesn't matter. It doesn't give much variation in the results. That's what I remember, but Ling can answer maybe.
No, we didn't do the correlation between the different currency pairs. But for the training data with the 14 currencies, those 14 currencies are not in this test data. So this test data never was used for to train the model. So we trained the model, we saved the model somewhere, and then we extracted we download the data from Oenda for another 5 currency pairs and the different time frame. And from this is like a simulated test data. So from these 5 data sets, we identify the sequence of the event 1, 2, 3, and then we think, oh, okay, this looks like the time to buy, and then we take it out and dump into the saved model, and then predict whether this is a good time to buy or we shouldn't buy, and this is the result.
Can I add to that? Though is Ling who's done the work, but look at the model, the basis of the model. The base of the model is based on that trend. So it's actually the first feature engineering is calculating those events when they happen. So they are irrespective of the price. So even if you do the correlation analysis, even if your currency pair are correlated, I think it's still a very valid analysis and very promising results, because it's all based on those events, and those events do not depend on the price. Those events can happen anywhere in any market.
Does it make sense? Or if you got a counter argument, we're happy to listen that. It's a learning. It's a learning for us as well. If you got a counter argument.
I was just going to say, because if you're using currencies, because you have two pairs there, you, for instance, AUD and your Swiss. So if you're using AUD in your training, and then in some of your other training using Swiss, then you will have that data, a lot of that data, the correlation in your testing. So it will be very similar to your training data. So it's kind of dodgy to say that the trend is going to be different, because the correlation of a lot of those currencies will be the same for the two pairs.
So this was one of the experimentation. This was one of the testing. We did this 80-20 as well. So that also generated similar results. So, in that case, there was no point of correlation issue.
And what was the drawdown that you calculated on your testing data?
Sorry, I didn't get that one.
What was your drawdown that you calculated on the testing
We
data?
didn't calculate that one, but I think Link calculated this one. So we had the labeling was done 5 pips and 15 pips. So the stop loss was 5 pips, and the profit taking was on 15 pips. So if you see the red one, so these are the pips you lost. So I think you can calculate the lost pips multiplied by 10, so you can do the drawdown as well.
And from the highest point of your balance, what was the lowest point you reached?
Okay, we didn't do that one. We didn't do that one.
That's very important in terms of like the real world application of it.
You could have lost your whole balance.
So yes, that's true, but we can get the maximum number here, which is 160. You can multiply it 5 pips.
Okay.
No, thank you. That's very good arguments. Very. Okay, so Bassam, you are also interested in trading? I didn't know that.
Thanks a lot for this information. It's really interesting. So if I look at the results, so the total records that comes from the 4th row,
which is
so
M15.
This is actually, so this is actually influencing the profit. So that's actually the one that make the influence.
Mm-hmm.
And in particular, that one has actually the largest number of records compared to others.
Mm-hmm.
So, and I was thinking why first the total number of records are different, given that we have a start and end date for all of them. And in case we don't have this actually kind of trading between these two currency trades, so would it influence the results?
So what you are suggesting is that if we didn't have this 4th one, would have different results?
Yeah, I think.
Yes.
I think that also you're very well. It's just your concerns and questions are correct. That we had that British pound, and what's that PLN? Polish. Yeah. You want to say something, Nick? But while I'm walking to you, I'll answer this one. So this also shows us that maybe our models are good for 15 minutes, and they haven't tested on other currency pairs. They only tested on the daily, but maybe that's something we can try for the next semester, isn't it?
Because the 4th one has more events happening. Yeah. It's because, did you see that the 4th row, it's M15, 15 the time frame. Yeah, it's more. It's totally over 364,000 data in the 4th currency pair. But for others, it's daily data or H1 data or H4. So they have less events happened and less data.
Yes. Yeah, that's right. So that shows maybe we should be trying more and more in 15 minutes for the future models. Because we got more data points, and we can there's more opportunities to generate profit probably.
Yeah, my question is, why did you choose 15-minute intervals for the British Poland currency pair and 1 hour intervals for the Australian dollar, whatever? Yes, franc. Random. Okay.
I think they were running out of time and wanted to finish with something, isn't it? Yeah. More questions? We got okay. A couple of questions in the front.
So you were saying your training data is starting from 2005 and end on 2019, and your testing data is also starting from the same date and end on the same day. So how your model gonna work in real world? Because in real world you won't have you can't train your model on the same data frame when you're doing the prediction, because you are training on historical data and you make prediction on in the future. So yeah, so my question is why you're using the same data frame for training and testing? Yeah. Okay, thank you.
Someone here? Yeah. Yep.
Okay, thank you. So my question is, if you go back to the trend picture, so what is the theory behind you are trying to find out the trading opportunity after trend, like the point 3, event 3? So what is the theory behind that?
This one. So if you look at the first red one, so this is our event 1. That event 1 represents the change in trend. So that is the optimum point when you can make the maximum profit. But it is very hard to detect this point. The confirmation of the trend, we have found out the confirmation of trend depends on these 3 events. And this is what we have found out. So sorry?
Is there a theory?
So there is no written theory, but from the market traders, we have the market collaborators who have been working in the industry for so many years. So they have different strategies, and this is one of the strategies. So this is the domain experts' knowledge, and that's what we have utilized here to do the feature engineering.
How do you identify the
So that's the problem we have solved. The event 3, we had predicted, we had classified the points after event 2 has happened. We have classified the points as event 3 or not.
How do you find out the event 2?
So event 2 is the crossover of the indicator.
Yeah, but it depends on which indicator you are trying. Because the moving average has like 30 moving average. So each one is different. So how do you rely on which indicator you are trying?
So we have used, again, we have used some domain experts' advice here. And there are some papers which talk about this one. So they have some numbers in literature which suggest that these numbers represent good crossovers and they represent the turning point of the market.
Yeah, so if you need more information, obviously we can do a follow-up, and we're offering this as a capstone or as a project as well. So if somebody is interested, we can talk about that as well. So obviously we haven't discussed each and every minor detail. We just give a bigger picture what's happening and how it's happened. So I understand that some of your question hasn't been fully addressed, because otherwise we'll be spending just the next hour on this question. Does it make sense? So yeah, so we can follow this up if you're interested. You come on board on the project, and then we can discuss this in detail.
Okay, so my question is, why did you treat, for both of these projects, why did you treat it as a classification problem and not a regression problem?
For this classification is an easier. End of the day, we want to make money, and if we can invest $2,000 and make $20,000, what else do we want? So the classification is the easiest way of dealing this problem. It could be dealt with regression, but then it's harder. That's the only reason. So guys, I think we have quite a few food still left, so we can still hang around, continue eating, and we can continue talking over the food. Thank you very much for coming, and we'll see you around.
Yes. We have so many. We have so many. So this is one of the things. So there are 50 indicators. Those 50 indicators, they have different events happening. So we have just captured 3. We don't know what other events will result better. No, I've done my PhD. I'm done with everything. I'm just supervising these projects.
Are these slides available on for use?
No, I don't think so. No, I don't think so. They are not available somewhere, because these are prepared by Matlub and he just put it here. I don't think so. They are available somewhere.
Can I get it here?
Maybe you can ask Matlub. Yeah.
Choose the event 1.
How to choose the event 1?
Event 2, I saw that crossover.
Okay.
2 make the 2-line crossover. So randomly choose or not randomly choose?
It cannot be random.
Yeah.
It cannot be random. Yeah. So that's why, if you remember, we had discussed this point, this zigzag indicator. So this zigzag indicator basically is the one which gives us this event 1. So this is an event which happens in that indicator. Yes. So this is one of the things. We have so many other things which we want to try out, and if you are interested in this project, you have.
This project will be offering in coming capstone.
Yes.
So last year I actually just admitted, but actually I have taken only 2 subject every semester, so that's why I left that. I did another course. But there was a thing of automatic trading using the. So this software is implement automatic trading, like going to buy.
So that's what we said. We had developed this model. We have tested this model, but we want to test it on the live market. We haven't done that. We had only limited time in this semester. So we want to continue this work. We want to go forward. We want to do things. And hopefully when the students will join this project next semester, you know, they will do this.
Join this project, they will start from the beginning, or they start on top of this, or how?
So basically, there are a few directions which you can take, and it depends on your interest and your background. So let's say you have a strong background in deep machine learning. So we'll try to use that. We'll try to branch out and do something else. If you have good background in finding out, you know, events, if you have good background in feature engineering, we will try to do that one. So we have so many different branches which we can, it's not just one direction project. So it is, and there were so many other projects. This is one project out of those projects. Okay, so almost all the projects they did differently. Okay.
The result is published. Can we know more details about this project?
When the results will be published?
Just your current results.
At the moment, we were writing something, but it's still, you know, it's work in progress. We haven't published anywhere yet because semester just finished. You know? So we haven't.
Is there any way I can know more detail?
Yeah, you can make an appointment with Dr. Matlu, okay, and just make an appointment. Discuss with him if you are really interested. You know, discuss with him. He can give you more details, what you can do, what are the other options, all of that. Yeah.
Still curious about the training and the testing. Like, so you're using like the training is like from the 2005 to 2019, and the test is the same, but different currency.
So no. So this is, let me tell you this. Where was that? So look at this one. So when we did the classification, we did use the 80-20 one. We did all the proper testing, 80-20 divided, you know, scaled everything. This, I know why people are, you know, curious.
Yeah.
So this is just to give, look, if I give you a number 94%, doesn't make much sense in terms of money. Okay, so that's why we wanted to have something, you know, to give more interest for the people. See that if we had used this model on these currency pairs, this is the result which we get, and that's why I had to convert this into dollar numbers. Okay, so that's why it is a bit confusing that you have used it, you have tested it on the data which is 2005 to 2009. Okay, but this is completely unseen data. We didn't use this data to train our model. You got it? So if we hadn't used this data to train our model, what's the problem?
It doesn't have to be
So this is completely unseen data. It can, you can say this 2005 is starting from now. It's like the same. So when she submitted the final report, after that, it's been like 3 or 4 weeks now. So after that, we have she has used it on for the testing on the live, you can say live, or the 1 month start, and we have got similar results. Okay, so okay, you can say it's not 97%, it's 94%, 95%. Doesn't make much difference when you have this much conversion rate.
It's just that.
It's just 1 month worth of that. So we want to, in our future project, we want to have testing on live data.
Yeah.
We want to have that. We want to have a model deployed somewhere so that we can use the live data and get the results. So again, this is a work in progress. This is not finished. This is not done. It's done up to this stage. Okay, always the research projects, they have this property. So they do not stop at some point. You have to continue to improve it.
Yeah, you're still testing.
Yeah. So yeah. So let's say we test it for next 1 year. Okay, then we will be able to say something better than this one.
Okay, it's probably must be done.
I don't know.
Yeah.
I don't know. But I believe that it will give a similar result. Yeah, that's what back testing on different currency pairs, back testing on different time frames, it gives similar results. Not exactly the same, you know that.
Yeah.
So not exactly the same, but almost similar. So if it gives you almost similar results, who cares? Who cares about that minor change in the results? Because that makes a lot of money. I mean, in terms of converting that number, it's not pure academic process. The target is not just academic excellence that, oh, we were able to achieve 99%. It's not the target. The target is this one, real world problem. Yeah, of course. And another thing is that we have used 15 pips and 5 pips as our barriers. Okay, so if the market reaches, if our profit reaches 15 points, we say yes, this is the trade. We can adjust these numbers.
So how you originally determine like the 15?
So we started with some numbers, we did some random numbers, and we said, okay, well, we had to ask the domain experts as well.
Yeah.
Okay, because they give you the better idea. Okay, if we had used 200 pips, maybe
probably not profitable.
Not profitable.
Yeah.
Maybe there are no events E1, E2, E3 for 200 pips. There are no labels for that. Let's say. So what's the point? 2,000 pips. Yes, you can do 2,000 pips, but if there are just 2 labels, it's too much. I'm just giving you an example. Yeah. So I'm just saying that you have to be reasonable to say something. Now with 15 pips, which is very nominal, which is very easy to achieve in normal market. Yeah, you can achieve something good. Okay. So even if you don't look at this 4th one, even then, if you don't look at this one, even then, in every pair you are making good money. So look at the first one, 317.32. So almost 10%. So that means 90% of the time you are making money. Yeah. Look at the last one. Look at the 3rd one. So it's because of that one, you are down 97% or whatever. But if you look at the other one, you know, it's almost 90% more than 90%.
Yeah, except for the second one is just
100%.
Yeah, but only 16, right?
Yeah. So, but that is D1.
Yeah. It's
so in that currency pair, those events did not happen frequently.
Yeah.
So
because the time frame ends on D1.
Yeah. So in those in that currency pair, in D1 time frame, only 16 times of that happened, and we have detected every time. So 100%. So we, of course, in coming days, what we want to do is we want to apply the model on 40 currency pairs. We want to see how it works. So those are the numbers which we will be generating soon. This is the result which we have achieved, and I'm really happy with that because this is
not been done before. So what other people have done is most of the time is predicting the market on each candlestick. So we are not predicting the market on each candlestick. We are using the features of the market to find out the best point in the market to do the trading. And out of those best points, we are predicting which one is the time, which one is the bar, which one is the candlestick when we should do the trade. And our model is telling us. So that's the whole idea. Yeah. Okay.
Yeah, I'm waiting for the publication.
Publications. I'm not sure when. It takes time. It takes time because obviously you put effort, there's a good group, working or you have to write the paper time, or I will have to write the paper. And the math and then but then there are some and I'm not just doing this. This is just one project in my life. So there are so many other projects. So we tell them, okay, use these numbers, use this form. So you are interested in background. What's your interest in this project? Next semester, I'm not teaching